Well, let's bring in some global opinion. Hartmut Issel is head of equity and credit Asia Pacific Chief Investment Officer at UBS. He's joining us right now. Hartmut, great to have you with us here. Thank you for your time. Appreciate it. I just want to start with something which we don't talk about very often at all, and I guess for good reason, because it's not really had a big impact on markets, at least not equity markets, which is geopolitics. There seems to be a bit of a, at the margin, risk of escalation, both Middle East and Russia, Ukraine as well. Oil's up 3%, gold is up 1.5%. Just your first thoughts as you look at the situation.
Yes, absolutely. I couldn't agree more. These tensions, they're not going away. And if you look a bit deeper, and you mentioned Ukraine war, for example, and so we've also seen instances of even all the way up to central bank asset freezing, only an isolated case, of course. But nonetheless, what we see as a conclusion for investors is that we like gold. And we like gold fundamentally, because you're seeing already the inflation coming off in the US enough for the Fed to really cut forcefully. And if the Fed cuts faster than inflation comes off, that's positive for gold, right? Because the competition from the rates is sort of diminishing. But yeah, we also see since almost 2 years now, the central banks, especially in emerging markets, are looking to diversify beyond the dollar assets. And naturally, gold is a choice that they will always look at. And also looks like they're not particularly sensitive even at which level they're going in, right? They want to do that diversification. So you have a couple of reasons beyond geopolitics. There's only one of them. So gold is really one of our preferred assets right now. And if I look into first half of next year, so the end of the first half, let's say we have a $2,700 target, which means you can look at almost 10% upside. So yeah, the answer to that question is, as an investor, you'd certainly look at gold at this point.
Okay, so gold looks like an interesting asset class. Got that, Hartmut. Let's talk about the other risks. So geopolitics is one of them. The other risk, obviously, that the market is grappling with is whether the central banks can steer the global economy into a soft landing, particularly the US, right? There's been so much debate about how many cuts will be enough and the timing of those cuts. If you do it too quickly, too often, then the market will get scared. If you don't cut enough, then will you get that hard landing? So where are you on that debate, and what do you forecast ahead for the US market itself as these cuts start coming through?
Yes, I think as also discussed on the program already earlier, the US economy is starting to soften. And the question is, does the Fed engineer a soft landing? We think, yes, that's the case. But beyond that, I would also consider the following. So if you look at what potentially is the neutral rate for the Fed, right? Roughly as an indication, maybe 2% inflation, 0.5% real. So you're talking about 2.5%. Well, multiple rate cuts away from that, until we're even neutral, let alone supportive, right? So what I would not underestimate for the U.S. market as well, that is the potential for the Fed, if they see, hey, things are slowing a bit beyond what we initially expected, they can cut faster. They're so far away from even neutral that I think can support the market. And long story short, also given that we see in the S&P already the first signs of evidence that the rally or the earnings growth, I should say, is broadening out beyond tech. So tech keeps, of course, good earnings growth, but other sectors are also starting to come back. So this is a picture where we think, all else told, with the rate cuts also that we expect, 5,900 is the target, a pretty decent upside for the US here until the end of the year.
All right, Hartmut, what about the Indian markets? We have been outperforming, we have been falling relatively less, and on the way up, we've been doing better. Earnings visibility as well as there out here with solid domestic flows. Your view at current valuations on the Indian markets?
Yes. However, I'd say very, very near term, very tactically. As you rightly suggest, India hasn't really participated, virtually not, in this correction. So then also, of course, because we believe there's going to be a counter reaction in stock markets, so you have more upside. So if India hadn't participated that much on the downside, it's also a bit difficult to see how it would outperform when some of the other markets recover. Another point I would also say is that last year was a really bumper year, right? Nifty at almost 20% earnings growth. So We're settling lower. As for this year, we have maybe 10, maybe slightly over 10%, something like that. It's still decent, right? But it's no longer 20%. So long story short, also tying in the valuations, as we all know, they're not particularly cheap at this point. Right? It could be that we're seeing a bit of a break, or at least a slower trajectory. So I'd say over maybe 6 months or so, perhaps expect something in line with earnings growth. So give and take maybe a 5 percentage points or so upside. But yeah, we have been a bit spoiled recently. Maybe the trajectory is a little bit flatter from here.
Yeah, I think that's the best way of putting it, right? We've been a bit spoiled, but let's see what this market can throw up. You're saying maybe another 5% from here. Good conversation, Hartmut. Thanks very much. You have a good rest of the day.